안녕하세요. ETF 내부자 정보를 전해드리는 이자입니다. 구독자분들 중에 엔비디아 투자하는 분들 많으시죠? 시총 1위 자리를 굳건히 지키고 있고 서학개미 보유금액도 테슬라와 1, 2위를 다투고 있는데요. 이 엔비디아를 기초자산으로 한 커브드콜 ETF 엔비디아이는 연 분배율 84%를 넘으면서 주목을 받았는데요. 최근에 엔비디아이를 뛰어넘는 예상 연 분배율 94%를 기록한 초고배당 ETF가 나왔습니다. 바로 NBII인데요. MSTU 등 레버리지 ETF로 유명한 렉쉐어즈에서 출시한 상품입니다. NBII는 커버드콜의 레버리지 전략을 접목해서 매주 고배당은 물론 본주 성장에 따른 차익을 노릴 수 있다고 합니다. 맥스에서는 이런 상품들을 그로스 앤 인컴 라인이라고 부르는데 현재 NVII를 포함해서 4가지 ETF가 있네요. 과연 어떻게 일드맥스를 제치고 초고배당을 달성했는지 또 레버리지 리스크는 어떻게 관리하는지 직접 물어봤습니다. 영상 끝에 괴리율 관리법과 장기 하락장 대응 전략까지 나오니까 끝까지 살펴봐주세요. 영상 내용은 출연자 개인 견해이며 어떠한 투자 조언, 자문 권유가 아니므로 참고용으로만 봐주세요.
Nice to meet everybody. My name is Taylor Ranney. I'm a senior vice president at RecShares, and I focus not only on distribution, but also client portfolio strategy. So working hand in hand with the portfolio managers and making sure that there's a proxy for the PMs, because everybody who's buying these products wants to make sure that the portfolio managers are sitting behind their computer screen every day, making sure that these are operating the way that they do. So kind of a dual function there. Yeah, of course. So, the question around bid-ask spreads being slightly wide a few months after launch, I think you can think about that two ways. One is, from our perspective, we aren't even at a 3-month track record yet. I think across the suite of the 4 growth and income covered call strategies that we have, we're roughly $65 million at this point. Bid-ask spreads tend to tighten as the products mature and as AUM and volumes increase. So, from our perspective, and we can certainly hit on this, but, one of the benefits of not being first to market, especially with these types of strategies, because options can inherently be relatively complex, is we're able to see what peers have launched in the past, and then we're able to iterate and innovate on those structures and create what we believe is a more optimized strategy. So as we look at performance and we see that these are tracking very nicely with what our expectations are, our assumption is that clients will start to take notice and investors will continue to add to their positions across these 4 strategies, in which case AUM is going to increase, volumes and liquidity will increase, and then naturally over time, bid-ask spreads will also tighten. As I just mentioned with the last question, we've had time to really iterate and innovate on what we believe is the most optimal structure. So a lot of peer products out there do focus almost entirely on maximizing income. With these names, you have such high implied volatility, which is a primary driver of the level of premium you're able to capture within any of these given names. And so our goal here is to appreciate and understand that investors are looking for strong income. But some of the issues that we've seen is massive amounts of NAV erosion with some other products out there. So our goal was to identify the optimal solution to balance growth and income across this suite. And so what that means is that we spent a ton of time and did many, many iterations of back tests on different leverage amounts. So we started with, just a delta 1 or 1 times leverage product. And we also back tested 1.05, 1.1, all the way up to 1.5. And essentially what we tried to do was create a similar exposure to the underlying name or stock from a total return perspective, while also being able to distribute a very high distribution rate. And so, 1.25 happened to be the sweet spot. And as we'll look at performance, what we've seen is that we are either slightly outperforming or slightly underperforming in certain cases, depending on the product that we've launched this point, relative to the underlying stock with a fairly high distribution rate at this point. So a lot of information and a lot of research went into identifying 1.25 as the optimal solution. What 1.25 leverage does for you is allows you to participate in a market rally slightly higher than what you would. And the other key fact here, which I haven't mentioned, is that we're writing on only 50% of the portfolio. So with a leverage ratio of 1.25 times, at any given point, we have at least 0.6225 or 0.625% of exposure to the underlying asset, right? So instead of it just being 0.5. So on a weekly basis, we're distributing income and we're writing options relatively systematically at 2% out of the money. And what that means is you will participate up to 2% for the covered call portion of the portfolio, so 0.625 or half. And then the other half will continue to rally in line with what the underlying asset is doing. So that's really helpful, like I said, in tech rallies or rallies for these underlying names. It's also important as markets draw down to be able to recover NAV. So again, with some of the products that we've seen out in the marketplace, NAV erosion has been incredibly significant. Some of these larger products have over a year and a half had their NAV decline 75%. They have incredibly attractive headline distribution rates. But you really need to think about this, and this is one thing that we did, and I think we did a really good job of it, of contextualizing this and thinking about it from a total return perspective. But if you have a 100% distribution rate, but that's on a NAV that's 25% lower than when you first bought it, your distribution is really 25%, right? And so you really need to think about that in a multifaceted context to come to what we believe is a better solution. So from a risk management perspective, that's another thing. Option exposures can again be inherently complex. What we've done at Rex across our traditional covered call strategies with FEPI, AIPI, and SEPI, as well as with these, is try and simplify that for the end investor. So, one of the beautiful things about ETFs is daily transparency. So you can pull down our daily holdings file and you'll see a few line items. You're not going to see 20, 30, 40 line items of a lot of different option exposures. So the way that we constructed these portfolios was kind of two different components. One is to mimic or provide exposure to the underlying asset. We will write a long call 1 month out at a certain strike price. And we will also write at the same exact strike price, same expiration, a short put. That combination gives us our long exposure. That's also where we get the 1.25 leverage. And so we roll that on a monthly basis. So the Thursday before expiration, we roll those two positions. That resets our leverage on a monthly basis and maintains our 1.25 long position. Then simultaneously, we're writing on a weekly basis. We're targeting 2% out of the money. We'll write the contracts and roll them on a Thursday. We declare our dividend or distribution rather on a Monday and pay it out on Wednesday. So it's relatively systematic in how we're approaching the exposure. So from that perspective, it is simpler for a portfolio management team to ensure consistency in how we're managing this. Now, from an actual risk management perspective, the team does utilize Bloomberg as their trading system. So as everybody knows, Bloomberg's incredibly well known. It's incredibly widely used. We have all of our compliance rules baked into that system. So if anything is flagged as non-compliant, the trades will not be able to go through. In addition to having those compliance rules or put into the system, the portfolio managers do also do a secondary check. So anytime the primary trader, say for that day or for the portfolio, is going to put on a trade or execute an option contract, there's a secondary trader that does have to confirm the trade before it's able to be executed. So you have multiple steps, both kind of quantitative from the trading platform system, as well as double checks from a human perspective to ensure that human errors are mitigated. Second piece on premiums and discounts. I know that's something that we wanted to cover here as well. So premiums and discounts do naturally happen within the ETF ecosystem. Luckily, the way ETFs were designed and the way the ecosystem functions is somewhat self-correcting when it comes to premiums and discounts because of the participation from authorized participants and market makers. And market makers are incentivized to basically arbitrage away any premium or discount within a product. So with that being said, you're not going to run into, or you're very infrequently, you would run into a situation where you would have a meaningful, persistent discount or premium. There's nothing that, I would say we can do other than, lean into, and Rex does have incredibly strong and deep relationships across the market maker community. So if we do see any type of issue like that, we're actively engaging with those participants and making sure that we can close those gaps in a very efficient and effective manner. We're talking about a prolonged market downturn, right? Our strategy targets a leverage ratio of 1.25. For prospectus, we do have a range of 1.05 to 1.5. The reason we have that range in there is because the leverage is reset on a monthly basis. So for the leverage to hit 1.05 or 1.5 times, you'd have to have pretty persistent and extreme market movements, typically in one direction, to affect leverage within a 1-month period. Now, if we're talking about prolonged market downturns, it's a notable difference versus a sharp market sell-off, right? So, when I talk about our traditional covered call strategies, the worst case scenario in those is, these are our monthly expiries, right? So they're rolled on a monthly basis, is a sharp market sell-off like what we saw in early April of this year. If you then rolled your option contracts at that trough at the bottom, and then there was a V-shaped recovery, you've all of a sudden capped your upside for that month. For arguably no reason, it was a market overreaction. With these strategies, it becomes a little bit more nuanced in the sense that the distributions are weekly, right? So half of our portfolio, you can say, is capped at roughly 2% on a weekly basis. The other half is uncapped. So you're always going to have the ability to rally even through a prolonged downturn. Now, 1.2 times leverage is relatively modest, right? At Rex, we have 3 times long and short microsectors ETNs. We have 2 times long and short T-Rex single stock ETFs. With those, the leverage is resetting daily. So path dependency is incredibly important there, where you can be caught on the wrong side. With these strategies where you're combining the distribution, which is relatively substantial on a frequent basis, plus the ability to recover, and the fact that we're only covering 50% of the portfolio, it's that combined exposure that makes us feel more comfortable that a client's experience would be more in line with the underlying exposure. For example, if I look at MSII, right, our micro strategy growth and income ETF, of the 4 that we've launched, that has the most negative performance so far, right? As of yesterday, since we launched, it's down just under 15% total return. So that includes the distributions. MSTR itself is down just over 15%. So despite us having some inherent leverage within the portfolio, the distributions do outweigh that drawdown. And this is MicroStrategy's, it's been a relatively stable drawdown, of 15%, but we've been able to keep pace with that and be able to produce distribution. So on the downside, again, our expectation is that we're able to provide like experience to the underlying equity.